everyone's favorite topic, taxes. Except this time, we're talking about the kind that can quietly take a 30 to 40% bite out of your crypto gains before you even realize what happened. And if you think the IRS isn't paying attention to your wallet activity, they've been sending out compliance letters since 2019, and they are absolutely not playing games. So let's back up and understand why crypto taxes hit so differently than your regular stock portfolio. Unlike traditional securities, crypto is classified as property by the IRS, which means every single trade, swap, or purchase you make with it is a taxable event. Yes, even buying a coffee with Bitcoin counts. Here's where most people walk into the trap, completely blindfolded. They see massive gains on paper, they celebrate, they reinvest everything, and then April rolls around like an uninvited guest demanding a check they can't write. It's the crypto version of winning the lottery and forgetting that the government is your silent co-winner. Now let's talk about what you can actually do legally. And the first move is so obvious, people sleep on it constantly, which is simply holding your assets for longer than 365 days. Long-term capital gains rates top out at 20% for most high earners compared to ordinary income rates. That can hit 37%. That patience alone can be the difference of tens of thousands of dollars. Tax loss harvesting is the next tool in the kit. And unlike stocks, crypto has no wash sale rule, at least not yet as of 2025. That means you can sell a losing position, realize the loss to offset your gains, and theoretically buy right back in the same day, which is a strategy Wall Street veterans use that crypto investors are just now waking up to. There's also the strategy of donating appreciated crypto directly to a qualified charity, and this one genuinely feels like a loophole that's somehow still legal. You avoid capital gains entirely on the appreciation and get a deduction for the fair market value. It's one of those rare moments where the tax code almost seems like it's rooting for you. Now, let's address the misconception that using a crypto IRA or self-directed retirement account is some kind of shady offshore scheme. It is completely legitimate and increasingly popular. You can hold Bitcoin and other assets inside a Roth IRA structure, meaning your gains could grow tax-free and qualified withdrawals cost you exactly $0 in federal taxes. Here's the part where the horror stories live, though. People who ignored cost basis tracking, mixed wallets, used DeFi protocols across 12 chains, and then tried to reconstruct everything in March. Software like Coinly, CoinTracker, or TaxBit exists precisely so you don't end up in a dark room with a calculator and an existential crisis. Gifting crypto is another underused strategy where you can give up to $18,000 per recipient in 2024 without triggering a gift tax, and the recipient inherits your cost basis. It's not glamorous, but neither is writing a check to the IRS for a gain you already mentally spent. Let's talk about the pitfalls that even sophisticated investors stumble into. And the big one is failing to report staking rewards and airdrops as ordinary income in the year they're received. The IRS has made clear these are taxable at fair market value the moment you receive them. And I didn't know is not a defense that ages well under audit. The irony is that the people most excited about crypto's decentralized, anti-establishment ethos are often the same ones most surprised that a very centralized government wants their cut. Structuring your portfolio with tax efficiency in mind from day one isn't selling out to the system, it's just playing chess instead of checkers. Historical cycles remind us that every bull run produces a new wave of investors who didn't plan for the tax bill, and every bear market produces a new wave of people who wish they'd harvested losses more aggressively. The lesson compounds the same way interest does, slowly at first, then all at once. The discipline here isn't about finding magic loopholes or exotic structures. It's about consistent record keeping, strategic holding periods, and making boring, unemotional decisions that your future self will quietly thank you for. Position sizing matters too. A well-diversified crypto allocation means a tax hit on one asset doesn't become a liquidity crisis across your whole life. Whatever the market does next, rip to new highs or grind through another correction, the investors who built a tax-efficient framework around their holdings will simply sleep better, and that peace of mind has real financial value. Preparation isn't pessimism. It's just the grown-up version of hope. And if you're ready to build real wealth across multiple asset classes with the right structure from the start, whether that's crypto, real estate investing, home contracting work, or finding the right lenders, check out our links in the description below.